They told you it was a lockbox. They told you it was a trust fund. They told you that every cent you worked for, every dollar stripped from your paycheck for 40 years, was sitting in a vault with your name on it, waiting for your golden years. But what if I told you that the vault is empty? And I do not mean running low. I mean physically, mathematically, and criminally empty. The year 2033 is etched on the calendar of every economist in Washington, D.C. like a tombstone. That is the year the Social Security Trust Fund officially hits zero. The official narrative says this is just a demographic problem. Too many retirees, not enough workers. They say a small tweak to taxes will fix it. But what if that is the lie they need you to believe to keep you working? What if the collapse of Social Security is not an accident, but a mathematical certainty engineered decades ago? We are not looking at a simple bankruptcy. We are looking at the largest wealth transfer in human history. The heist has already happened. You just have not received the receipt yet. If you have noticed that your grocery bill has doubled while the government tells you inflation is under control, you are already feeling the aftershocks of this hidden collapse. They are not going to tell you they stole your retirement. They are just going to make sure that when you finally get it, it won't buy you a loaf of bread. Before we crack open the books on this crime scene, I want to know who I'm talking to. Drop a comment below. Tell me where you're watching from, and if you think you will ever see a dime of your Social Security. And if you are tired of the sanitized, government-approved version of economics, hit that subscribe button right now. We are about to expose the unfiltered truth that Wall Street prays you never figure out.
To understand the heist, we have to go back to the scene of the crime, 1935. When Franklin D. Roosevelt signed the Social Security Act, it was sold to the American public as social insurance. The marketing was brilliant. It painted a picture of a savings account. You put money in, it earns interest, and you take it out. It was moral. It was fair. It was American. But the ink was barely dry before the government realized they had created a pot of gold they could not resist touching. By 1939, the narrative shifted. They moved from a full reserve system, where the money actually sat there, to a pay-as-you-go system. This means the money coming out of your paycheck today is not being saved for you. It is being mailed directly to your grandmother. You are not investing. You are paying a tax to fund current liabilities, hoping that some future unborn generation will do the same for you. In financial terms, when a private citizen uses new investors' money to pay off old investors, we send them to prison. We call it a Ponzi scheme. When the government does it, we call it intergenerational solidarity. Sound familiar? It should. This is the exact same logic used in modern corporate stock buybacks funded by debt, borrowing against a future you cannot guarantee, to pay for a party today. The math in 1940 was a dream. There were 42 workers paying in for every one retiree taking out. The system was swimming in cash. The first recipient, Ida Mae Fuller, paid in a total of $24.75 in payroll taxes. She lived to be 100 and collected $22,888.92 in benefits. That is a 90,000% return on investment. That miracle created a moral hazard, the belief that the government could magically multiply money. But demographics are destiny. Today, that ratio has collapsed from 42 to 1 down to roughly 2.8 to 1. By 2035, it will be 2.3 to 1. The parallels to today's housing market are chilling. Just as boomers bought houses for $30,000 that are now selling to millennials for $500,000, the early participants in Social Security looted the value, leaving the bill for the current generation. In 1983, the government saw this coming. The Greenspan Commission claimed they fixed Social Security for 75 years by raising payroll taxes and the retirement age. They promised this would build a massive surplus,
to handle the baby boomer retirement wave. They promised a surplus of trillions. Sound familiar? Just like in 2008 when they told you the banks were capitalized, or in 2021 when they told you inflation was transitory, they lied. Here is the dirty secret of the 1983 fix. There was a surplus. Trillions of dollars flowed in from your paychecks, more than was needed to pay current retirees. But that money did not go into a vault. It did not go into the stock market. It did not go into gold or real estate. Every single dime of that surplus was taken by the general fund of the U.S. government and spent immediately. It was spent on wars. It was spent on tax cuts. It was spent on bureaucratic expansion. Sound familiar? It is the same way a failing company raids its employee pension fund to pay the CEO's bonus right before declaring bankruptcy. The government treated the Social Security Trust Fund not as a savings account, but as a slush fund to disguise the true size of the federal deficit. They spent your retirement to buy your vote today, and now the bill is due.
So, if they spent all the cash, what is in the trust fund? This is where the true mechanism of the collapse kicks in. This is the twist that most people simply cannot wrap their heads around because it is so audaciously corrupt. If you walked into the Social Security Administration in Parkersburg, West Virginia, and asked to open the safe, you would not find cash. You would not find stocks. You would find a filing cabinet full of paper. These papers are called Special Issue Certificates of Indebtedness. These are not standard treasury bonds that you can sell to China or Japan. They are non-marketable securities. They are essentially IOUs written by the government to the government. Let me simplify the mechanism. The Treasury takes your Social Security tax cash. They transfer that cash to the general fund to buy fighter jets and pay congressmen. In exchange, they print a piece of paper, a special issue bond that says, "We owe Social Security this money back with interest." They put that paper in the filing cabinet. The trust fund is an accounting fiction. It is a claim on future tax revenues. The government owes itself nearly $2.7 trillion. Think about that. If you take $100 out of your right pocket, spend it on pizza, and then write, "I owe me $100" on a napkin and put it in your left pocket, do you have $100? No, you have a napkin and a pizza you already ate. But here is the cliffhanger. The government argues, "We always pay our debts. These bonds are backed by the full faith and credit of the United States." But how do you pay back a debt when you are already running a $2 trillion annual deficit? You cannot raise taxes enough. That causes a revolt. You cannot default. That destroys the world economy. There is only one name for the solution they have chosen. It is a receipt wilder than you think, and it involves a mechanism that technically keeps the promise while completely destroying your life. You will not believe the name of the entity that is about to become the buyer of last resort.
This is where we whip the mask off the monster. We need to talk about the inflationary death spiral and the monetization of debt. When the Social Security Administration needs money to pay retirees because tax revenue is no longer enough, they have to redeem those special issue bonds we just talked about. They take the IOU to the U.S. Treasury and say, "Pay up." But the Treasury has no cash. The Treasury is currently $34 trillion in debt. They are broke. So how does the Treasury get the cash to pay back Social Security? They have to borrow it. They have to issue new public debt, Treasury bills, and bonds to the market to raise the cash to pay off the internal debt to Social Security. It is robbing Peter to pay Paul. But Peter is broke too. Who buys this new debt? In a normal world, it would be investors. But investors are getting nervous. The U.S. debt to GDP ratio is over 120%. We are in the danger zone. If the Treasury floods the market with trillions in new bonds to save Social Security, interest rates will skyrocket, crashing the housing market and the stock market. So, the private market will not buy enough. This leaves only one buyer, the buyer of last resort.
The Federal Reserve. This is the primary mechanism of the heist. The Federal Reserve will print new currency out of thin air to buy the Treasury debt. This is called quantitative easing, or monetizing the debt. The Treasury gets the printed cash. They give it to Social Security. Social Security puts it in your bank account. The check clears. The number in your bank account goes up. The government celebrates. We saved Social Security. We did not miss a payment. But here's the tragedy. That money was created from nothing. When you print trillions of dollars without creating new goods and services, you dilute the value of every existing dollar. This is the zombie dollar thesis. Let us look at the numbers. They are terrifying. In 2020 alone, roughly 40% of all US dollars in existence were printed. Look at what that did to prices. Now imagine doing that every single year just to keep Social Security afloat. The Social Security Trustees Report projects the trust fund depletion by 2033. At that moment, by law, benefits must be cut by 21% across the board unless the gap is filled. The US dollar has lost 97% of its purchasing power since the Federal Reserve was created in 1913. The heist is not a singular event. It is a slow-motion bleed. To maintain current benefits, the payroll tax would need to jump from 12.4% to over 16% immediately. That is a massive pay cut for every working American, destroying the economy that supports the retirees. The unfunded liabilities of the U.S., including Social Security and Medicare, are estimated at over $175 trillion. That is nearly 7 times the entire U.S. GDP. This is parasitic finance. The host, the productive economy, is being eaten alive by the parasite, the debt obligations. When the government chooses to print money to fill the Social Security hole, they are enacting a shadow tax. Imagine you are in a lifeboat. The government promised you a ration of water, but they drank it all. So, to fulfill their promise, they take a bucket of seawater, which is inflation, mix it with the remaining drop of fresh water, and hand it to you. The volume is the same, the cup is full, but if you drink it, you die. This is the illusion of solvency. They will pay you. Oh yes, they will pay you every single cent they promised. But by the time you get that check in 2035, a gallon of milk might cost $20. A modest apartment might rent for $5,000. Your $2,000 Social Security check will technically arrive, but it will live on the poverty line. This is the soft default.
A deep, hard default is when the government says, we are not paying. That causes riots. A soft default is when they pay you in devalued currency. It achieves the same thing. The government erases its debt by destroying your wealth. But because the nominal dollar amount did not change, nobody riots. They just get poorer, slower. It is a calculation of pure greed and moral hazard. The politicians making these decisions today will be dead or retired by the time the hyperinflationary check arrives. They are trading your future survival for their present-day power. This is why they hate Bitcoin. This is why they hate gold. This is why they hate assets they cannot print, because those assets act as a scorecard for their failure. The mechanism is designed to strip mine the middle class. The wealthy own assets like real estate and stocks that rise with inflation. The poor rely on government handouts that adjust slowly with inflation. But the middle class, the retiree who saved cash, the worker on a fixed income, they get crushed. This is not a bug in the system. This is the system. The stakes have never been higher because the modern system is faster, digital, and interconnected. In 1935, a crisis moved at the speed of the mail. Today, a loss of confidence moves at the speed of fiber optics. When the realization hits that the Social Security Trust Fund is just a filing cabinet of IOUs payable in zombie dollars, the flight from the currency will be instantaneous. We are suffering from a collective denial. We want to believe that the institutions built by our grandparents are structurally sound. We want to believe that if we just vote harder, the math will change. But math does not care about your political party. Math does not care about your feelings. The math says we are living on borrowed time. The government has two choices in 2033. 1. Cut benefits by 21% and face 60 million angry retirees. Or 2. Print the money, save the face value of the checks, and ignite an inflationary firestorm that burns down the purchasing power of the working class. History tells us they will choose option 2 every single time. They will choose the illusion. They will choose the soft default. So the question is not, will Social Security bankrupt? The question is, will you be bankrupt when Social Security pays you in worthless paper? You cannot rely on a system that requires the destruction of the currency to function. You must become your own central bank. You must understand that the safe path, relying on the government promise, is now the most dangerous path you can take. I want you to think about this video the next time you see a politician promising to protect Social Security without cutting spending. Ask yourself, are they protecting the value or just the vote? If this opened your eyes to the heist happening in slow motion, share this video with someone who is banking on that government check. Wake them up. Are we wiser now, or are we just walking the same path as 1930, just in better suits? Hit subscribe for the unfiltered truth, and I will see you on the other side of the collapse.